All right, let's get right into it. The end of the year is coming up fast, and with the markets going absolutely bonkers, now is the perfect time to talk about the smart money moves you need to be making right now for October 2025 and beyond.
I've got a question for you. What if the next 3 months, what if they determined your entire year's financial success? And I'm not exaggerating here. The stakes, they are incredibly high right now.
I mean, you've seen it. Gold is hitting record highs, markets are all over the place, and a single wrong move right now, it could cost you lakhs. But don't worry, that's why you're here. We are going to break down the exact blueprint to get through this.
Okay, first things first. Let's talk about the big growth opportunities. We're not just throwing darts at a board here. We're following the data, finding out where the real money is flowing.
And first up is tech and AI. Just look at this number, $300 billion. That's what India's IT sector is expected to hit by fiscal year 2026. This isn't just some passing trend, folks. This is a massive economic shift, and it's all being driven by AI, the cloud, the whole shebang.
So, the big question is, how do you get a piece of that pie? Well, the smart play is to stick with the big guys, large-cap IT stocks. And the easiest way to do that is through mutual funds or ETFs. And get this one sector makes up almost half of India's services exports. Now, here's a key tip. Avoid those tempting small-cap tech stocks. Seriously, they're just way too risky right now. Your best friend here is a simple systematic investment plan, an SIP. Just set it and forget it in a good tech fund for the next 12 months.
Okay, you thought that last number was big? Take a look at this one. $6.5 trillion. That's how much India needs to invest in its clean energy transition by 2050. Let me be clear, this isn't just an opportunity. This is how generational wealth is going to be made.
Yeah, we're talking about a full-on gold rush in renewable energy. You've got solar, you've got wind, and the whole EV infrastructure. The big players, think Tata Power, Adani Green, they're leading the pack. And with the government pushing hard with those production-linked incentive or PLI schemes, this sector could see 15 to 25% growth in the next year alone. This is real structural demand, not just hype.
All right, growth is awesome. But let's be real. In a market this choppy, you have got to protect your downside. So let's pivot and talk about our defensive hedges, the stuff that keeps you stable when things get crazy.
And your number one defensive play? It's pharma. Just think about it for a second. People need their medicine whether the economy is booming or busting, right? That makes the sector incredibly resilient. You could even say it's recession-proof.
So, why jump into pharma right now? Well, for one, the whole sector is kind of undervalued, which means it's a great time to get in. Plus, you've got these huge long-term drivers like our aging population and a boom in medical tourism. We're talking about the steady giants here, Sun Pharma, Dr. Reddy's. The smart move? Carve out about 15 to 20% of your portfolio for these guys. It's your stability anchor.
Okay, let's address the elephant in the room. Gold. It's everywhere in the news, hitting all-time highs. And I know, the temptation to jump on that train is huge. But the smart money plays this game very, very differently.
And this slide nails the difference perfectly. The wrong way? Chasing those record highs, buying physical gold and just praying for a quick profit. That's just gambling. The smart way? Use gold as insurance. You're hedging against all this craziness. And you do it through sovereign gold bonds, which, by the way, pay you a 2.5% annual interest on top of everything else. So remember the key takeaway. Think insurance, not lottery ticket.
All right, listen up, because this might be the most important part of our chat today. Knowing what not to do is often more important than knowing what to do. So let's run through the biggest investment traps you have to avoid right now. First up, trap number 1. Buying real estate on heavy leverage. Look, prices are sky high in a lot of places, and interest rates are no joke. It's a dangerous mix that could leave you totally over-leveraged. Trap number 2. Please stay away from small cap and penny stocks. When the market turns sour, and believe me, it will, these are the first ones to get completely wiped out. It's just not worth the risk. Don't be the one left holding the bag.
Trap number 3 is a sneaky one, those low-yield fixed deposits. Yeah, a 6 or 7% return sounds safe, right? But with inflation sizzling at over 7%, you are actually losing money. Your purchasing power is literally shrinking.
And here's a big one. Trap number 4, emotional investing. You know, FOMO, the fear of missing out.
Just because your neighbor's cousin is making a killing on some stock doesn't mean you should pile in. That herd mentality, that's exactly how bubbles get created and how they burst.
And last but not least, trap number 5, ignoring your tax-saving options. I'm talking about things like equity-linked saving schemes, the Public Provident Fund, and the National Pension System. These things not only grow your money, they save you a ton on taxes. Ignoring them is literally like turning down free money.
Whew, okay, so we've covered the opportunities, the defenses, and the traps to avoid. Now, let's bring it all home and put it together into one simple, actionable plan. This is your smart money blueprint for the end of 2025.
So let's say you've got 1 lakh rupees ready to go. Here's exactly how you split it. 40% goes right into our growth engine, those tech and AI funds. Another 25% goes into that other megatrend, renewable energy. 15% goes to our defensive play, the pharma sector, for that all-important stability. 10% into gold, but through SGBs or ETFs, remember, as insurance. And the last 10%, keep it in liquid funds. That's your safety buffer. Boom, a perfectly balanced portfolio.
And the best part, managing this thing is super simple. Step 1, invest your money, just like we talked about, in those ratios. Step 2, put a reminder in your phone to rebalance it every 6 months. That's it. That's all you got to do to make sure your strategy stays on track.
So, what's the big takeaway here? It's that your timing and your allocation right now are everything. The smart moves you make in the next few months aren't just for next year. No, the wealth you build now is going to compound for years and years to come. This is your moment.
Okay, now I want to turn it over to you. We've laid out a blueprint, but I know everyone's situation is a little different. So what's your investment strategy for the rest of the year? What are you buying? What are you selling? Let me know. Drop it in the comments below.
And hey, if you found this helpful and you want more honest, no-nonsense financial advice that's backed by data, advice that will actually help you build real, long-term wealth, do me a favor and smash that subscribe button. Thanks so much for watching, and I'll catch you in the next one.